Welcome to the second session of our winter term morning webinar series by the Institute of International Monetary Research in collaboration with the Vinson Centre for the Public Understanding of Economics and Entrepreneurship at the University of Buckingham. I'm Dr. Juan Castañeda, Director of the IIMR, and today we'll be hosting Professor Tim Congdon. Tim is one of the world's leading monetary analysts. He advised the UK's Conservative government on economic policy from 1979 to 1997, serving as a member of the Treasury panel from 1992 to 1997. In his period on the Treasury panel, he emphasized the importance of monetary variables in the determination of macroeconomic outcomes. He's the UK's leading exponent of the monetarist school of thought and was influential indeed in the late 1970s and early 1980s in the defense of Thatcherite monetarism. After starting his career as a journalist on The Times, he became an economist in the City of London in 1976. He founded the research consultancy Lombard Odier Research in 1989, which he left in 2005. Since then, he has written extensively about monetary theory and practice. In 2005, he published a pamphlet on money and asset prices in boom and bust. In 2009, a critique of the Bank of England's conduct in the Northern Rock affair called Central Banking in a Free Society. In 2007, a collection of essays on Keynes, the Keynesians, and monetarism, and 4 years later, another collection with the title Money in a Free Society. And finally, his latest book is an edited volume by himself in 2017, Money in the Great Recession, with a collection of different contributions on the topic. Tim Congdon is the founder and chair of the Institute of International Monetary Research, and he was its first director until January 2016, yes, indeed. Today, we will discuss banking in a free society, after which we'll allow time for Q&A with viewers at home. Today's presentation will be recorded and made available on our YouTube channel. Questions must be submitted via the Q&A option, and I will moderate them and address the speaker. Thank you very much, Tim, for accepting our invitation. We're looking forward to your presentation.
Well, thank you, Juan, and hello, everyone. This is going to be a perhaps a rather, not disorganized, but a very ambitious presentation. The kind of pretext is this research paper that I wrote for the Institute some years back now. It was actually printed last autumn and distributed the last just a few weeks ago. It's called How Have Changes in Regulation Affected UK Bank Credit Since the Great Recession? And this has somehow been transformed into banking in a free society. Well, we're going to see that these two questions are indeed related. Essentially, what I'm going to do in the next 35 minutes is to present a general argument about the costs and benefits of banking in a free market economy, a modern liberal democracy, if you wish. I'm then going to discuss what happened in the run-up to the great financial crisis and Great Recession of 2008-2009. There was then a dramatic change in the way that banks were regulated, and I'm going to look at what happened after that. And so there is, and through all of this, there is, I think, an argument, although it may be clearer at the end than it is now. Now, the fundamental question in all of this is, does banking benefit the economy and of course, society as a whole? What are the social costs and benefits of a banking system? And I take it we're living in modern liberal democracies. You might think that this question has been answered. This pair of questions has been answered, hasn't been, or at least there are a range of answers and they conflict. The differences of view about the benefits of banking has then been basic to public policy towards the banking sector in the last 20 years. This is a question that goes back historically. Plato, ancient Greece, didn't like the payment of interest. And then there's a whole range of thinkers, often talking in a religious context, that denounce finance, denounce the payment of interest, and this is still with us today. This is one of the critics of banking, Thomas Jefferson, early on in American history, after independence. Whether he actually said these things is for discussion, but this quotation is usually attributed to him. And he says that banks shouldn't be allowed to issue money. If they do, their children will wake up homeless on the continent their fathers conquered. The monetary creation power should be taken from the banks and restored to the people to whom it properly belongs. At the same time, we had, more or less, the same time, we had Alexander Hamilton taking a very different, much more pragmatic view. Most commercial nations have found it necessary to institute banks. I was thinking, of course, particularly at that time about Britain, from whom the United States had just broken away. And they have proved to be the happiest engines that ever were invented for advancing trade. You might think this is a little bit old-fashioned, but this debate is important to what happened a bit over 10 years ago in the banking crisis of 2007, 2008, and on into 2009. And this is a quotation from Irving King, who was governor of the Bank of England in the decade to 2013. Lord King has given an outstanding public lecture for the Institute only a few months ago. I'm very grateful to him. I think he's a wonderful public servant and did many great things. However, I disagree totally with what he says here. What he says here is a speech in New York titled Banking from Bagshot to Basel and Back Again. What he says in that speech, of all the ways of organizing banking, the worst is what we have today. And he published a book under the title The End of Alchemy, and where some of these ideas were developed further. But this is what I'm trying to refute and criticize. Irving, I hope we're friends. Having said that, we disagree strongly about these matters. I'm just going to now have a short commercial break. If you want to find out more about these topics, do come to the MSc course on money, banking, and central banking that we give at the University of Buckingham. I spend the first 2 lectures of my lecture course explaining why modern banking exists as it does, defending it. And I discuss, if you wish, the magic of money creation and defend it. And this is what this alchemy of banking that Irving, along with many other figures, going back, I say, Thomas Jefferson, that Mervyn condemns. Let's be clear that the banking system is inherently very risky, as I'm now about to explain. What do banks do? They take in deposits. They must repay these deposits with cash. They then, to make a profit, they lend out these deposits and charge interest on the loans. And the difference between the interest they pay on deposits, if they pay any interest at all, and the interest they receive on the loans is their profit. And then, of course, we're living in capitalist economies where investors seek a proper return on equity. The banks must earn a return on capital at least similar to that in the rest of the economy if capital is to stay in the business. So banks have got some cash among their assets to repay deposits, and they must have a cushion of equity as well, so if something goes wrong with their loan portfolios, they can still repay the deposits. And the implication of all this is that, I just made it a little bit complicated, it is important what I'm about to say. So as discussed in our MSc course at Buckingham, Suppose that the margins on loans are given. Then the more that the bank is leveraged, more that banks are leveraged, the higher the ratio of loans to equity, the higher the return on equity. And obviously, there's therefore a temptation for banks to take too much risk and to have too large a loan portfolio relative to the capital that they have for the safety of. Must also, of course, retain some cash. But they want to have as little cash as possible because in its purest form, just simply vault the cash, banknotes, or in the old days, gold and silver, cash pays no interest at all, unlike loans. So banks are going to try and reduce the ratio of cash to all their assets. In a phrase, banks are inherently both highly leveraged, have a high ratio of assets to capital, and they're also fractionally reserved. They have a low ratio of cash to their deposit liabilities. And then let's just be clear that banks know that what they're doing is, of course, was a very famous theorist of banking. He was a banker himself, but he wrote a brilliant book called Bank Credit, 1921, a chap called A.W. Phillips, where he said the essence of banking consists in the practice of extending the loans far in excess of either the capital or the cash holding of the bank in question. And there's a constant issue of judgment and balance in this part of the banking business. It's the essence of the banking business. Now, let me just now say what I've argued so far, that this gives us some insight into the benefits that banking provides to society. Let's take it that it isn't the loan margin that's given, but the rate of return on capital. That must be competitive with the rest of the economy. But the lower the cash ratio, the greater the fractional reserving, and the higher the leverage, the lower the loan margin that the bank can offer to its customers and still make a decent return on capital. And the lower the loan margin, the lower the cost of the services that the banks provide to their customers. And it's really the customers who then benefit from banking. And the result of low cost finance from the bank industry is to raise what economists call the equilibrium ratio of capital to labor, the capital intensity of production, number of machines per worker, which then raises output per head and living standards. So this fractional reversion and leverage is all in it. It's absolutely basic to what banks are about. That's then another aspect of all this. Banking began initially from, there's various ways of explaining how banking began, but the typical explanation is thinking about goldsmiths who weren't in banking at all, but they had some gold in vaults. They realized they could lend out some gold without taking too much risks, taking gold from their customers, the depositors, lend it out, and some interest on the gold. Loans were partly given, just obviously initially in gold, but then people realized that the notes they took for the deposits of the gold could be used to make payments. And then there was this magic moment, this alchemy. This is what Mervyn King complains about, where the banks realized they can make loans not in gold. Goldsmiths realized they can make loans not in gold, but actually in the notes. That's where banking begins. They can expand a business by adding identical amounts to both sides of their balance sheet, notes on one side, loans on one side of the balance sheet, deposits on notes on one side, the loans on the other. The loans are assets, the notes or deposits are liabilities. Apparently it comes out of thin air. Banks don't need deposits to make loans. It's magic. It's dishonest, is it? And this is where you get the critique that what banks do is wrong, that it's a kind of alchemy, it's a kind of dishonesty. But I would say it's this essence, this feature of banking that enables banks to extend overdrafts in particular. The virtue, the beauty of overdrafts is that, think about two kinds of loan. A loan that's fixed sum, got to pay the interest relative to principal every day, every week, and so on. Or there's an overdraft facility which you use when an opportunity arises. So think about traders in commodities, traders in stocks and shares, traders in components, finished products, traders of anything, cars, anything. The overdraft is a very attractive kind of finance. And so what you find is that historically, that when you get a banking system extends overdrafts, you get near to it. See, nowadays, with overcoming these constraints of geography through IT and telephones and so on. But historically, you've had a banking industry close, a financial industry close to merchants, close to ship owners. This is the basis on which cities like London, New York, Hong Kong, and Singapore first got going. So let's now kind of bring this all together. Economic benefits of banking. The fractional reserving and leverage reduce banks' loan margins. That reduced the cost of bank loans to non-banks, companies, households, and so on, and raises society's equilibrium capital labor ratio, machines per worker, so output and living standards. And banks also provide overdraft finance, and that is very important for borrowers who are basically buying and selling things on a continuous basis, traders of one kind or another, borrowers with volatile and unpredictable balance sheets. I'd just like to say here that overdraft finance is very difficult to provide for capital markets. I often get this discussion of whether it's banks are good and capital markets good or bad, and debates about whether finance should pass through one kind of whether it should be intermediated through banks or pass through capital markets. Capital markets cannot provide overdraft finance to small and medium-sized businesses. Overdraft finance in particular relies upon the alchemy of banking, this ability to create money out of thin air. Okay, now, so then let's try and summarize all this. This is one of my critical points I want to make here. I've been talking really about a banking system where the assets are claims on companies, households, traders, financiers, financial sector as such, because there's non-bank financial institutions. The sort of argument I've been making doesn't make any sense if the bulk of the assets owned by the banks are cash, obviously, or claims on the government. Frankly, the size of the public debt has raised the relationship with the size of the capital stock, capital assets owned by the public sector. I'm afraid I'm pretty cynical about the ability of the public sector to manage capital assets in an effective way relative to the private sector. It's a discussion, but that's my view. I believe in capitalism. So I would say that the benefits of banking, which I've argued are important, arise only if the overwhelming majority of banking system assets are claims on the private sector. Now, I've tried to make a strong argument. I've set out the reasons for this relationship. I'm not the only person who said these things. There's a big literature on them. The empirical evidence supports the arguments I've just been developing. In the long run, in capitalist societies, the banking system grows faster than the economy as a whole as the economy becomes more sophisticated, more complicated, we move away from subsistence farming and self-reliant units. We instead have division of labor, specialization, and increased complexity. The banking system grows faster than output. as a whole, and there is a link between financial development and economic growth. And there's a number of a big literature about this, whatever the line taken by Thomas Jefferson and Mervyn King. Okay, that's the initial argument I want to set out. Now let's just think about some history. I'm going to now focus on Britain. The arguments are applicable to many societies, but I'm going to focus on Britain, really since the Second World War. And this is a run up to the financial crisis in 2008. In 1945, the British banking system was dominated by the London clearing banks. Let's get Dutch clearing banks too, but I was focused on London for the moment. Red shows claims on the state. Treasury deposit receipts, I won't go into detail now, are like treasury bills, investments, mostly gilts, cash at the Bank of England, treasury bills, this kind of thing. The great bulk of the assets of the banking system just after the Second World War were claims on the British state. It's understandable, there'd just been the Second World War and the government had needed to borrow on a large scale from the banks to finance military spending. We then have a period of about 25 years in which the banks, subject frequently to regulation, often told they couldn't lend to the private sector at all for a period, that they wanted to lend more to the private sector because they got better returns on that. And so we saw, this is the red bits, the claims on the state, the green bits are the claims on the private sector, mostly loans. You can see bit by bit that the green part of those bars was increasing relative to the red bit. So 30 years after the Second World War, lending to the private sector was beginning to become more important in the assets of the clearing banks. But even in the 1960s, early 1960s, the British banking system wasn't really helping the economy as a whole. It was so focused on having claims on the state. We then, so bit by bit, you can see the green bit becoming larger and larger relative to total. And then from the early 70s and even more from 1979 with the Thatcher government, the green bits of these, this is the loans of the British bank industry from 1970 to 1992, the green bit just soars. By the early 1990s, the assets of the banking system were just dominated by their claims on the private sector. At the end of the Second World War, UK banks had claims on the state, treasury bills, and so on, that were 6 times their claims on the private sector. From 1990 to the Great Recession, 2008, their claims on the private sector were on average 36 times their claims on the state. Now, you might think that having claims on the private sector, risky claims if you wish, is going to cause a lot of trouble. Just be clear that the bulk of that period was of impressive macroeconomic stability, so-called great moderation, and also moderate inflation. And I would argue that this is just before the Great Recession, UK banks' claims on the private sector are over 100 times larger than those on the public sector. Basically, they didn't have any claims on the state. They didn't have any negligible cash. They assumed they could always borrow from the Bank of England. And they had hardly any gilts giving a low return. They lent to companies, they lent to households, they lent to the overseas sector, they're competing, and so on. Total contrast the situation at the end of the Second World War and even with the 1960s. By the time of the Great Financial Crisis, Great Recession, this dominance of claims on the private sector had lasted for about a generation. It was normality for most people employed in British banking. Okay, so that's talking about and I would say also, crucially, that did Britain benefit from this pattern? I've already said that the years up, the 25 years up, the Great Recession, certainly 15 years were a period of stability. Growth of labour productivity was excellent. Britain, ever some peers in the early 70s, is going to be the poor man of Europe because it had weak growth compared with its European neighbours. These fears had been forgotten in the early years of the 21st century. And part of the reason was actually the competitiveness of the banking system, the British financial system, in general, banking system and so on. Huge growth of exports of financial services. And in 2009, these exports, just the exports, I'm not talking about the benefit to the UK economy domestically, were about 4%, the exports of 4% of GDP. Now, we then have, of course, the great financial crisis, and I'm about to explain what happened and what went wrong. And of course, all of this is now going to become very controversial. I'm taking a view which is not at all the consensus view. But what I've tried to do in the last 25 minutes is to explain how I've got to this point. In my view, what had happened to British banking in the post-war period, up to the Great Financial Crisis, up to the Great Recession, was positive and benign. And it was, if you wish, it was the Hamilton argument that had triumphed, and Jefferson and Mervyn King had been wrong. Basically, banking had benefited British society. Of course, what happened in the Great Financial Crisis, the first thing was August 2007, the global interbank market closed to new business. A lot of British banks, we can debate and discuss it a good idea. I don't think it was a good idea generally, but that they were financing their loans by borrowing from other banks in other countries. So these banks had a problem. Northern Rock was the extreme case, I suppose, but practically 70–80% of the British banking system had a problem. They thought that if this problem were to arise, they could borrow from their own bank, lender of last resort, Bank of England, as of course had been explained by a chap called Walter Budgett in a book published in 1873 called Lombard Street. Well, what they were told, they're given in August 2007 when they raised this issue with the Bank of England, they were given a pretty dusty answer. The Bank of England said, this is Mervyn King essentially, that it would only lend to banks in the UK against the security of government securities. But I've just shown you that in the 25 years up to 2007, basically UK banks had no government securities. They hadn't had any for, back from the early 1980s. And this was a huge problem for the banks in the closing months of 2007, early 2008, far more so than banks in other countries. And in the end, in April 2008, a special liquidity scheme was introduced, which treated banks asset-backed securities. They held a lot of asset-backed securities, which are supposed to be of the same caliber and the same quality as government securities. They were claims on the private sector, but they were very AAA rated and so on. These asset-backed securities would be treated as if they were government securities by the Bank of England. Hip, hip, hooray. But because of the trouble that banks had in this period, there was the view that the way to deal with their funding difficulties was to have more capital. Because they had more capital, they had more credibility in the interbank market. Not only that, but they would have to have a higher ratio of liquid assets, these available to sale securities, government securities to some extent, cash certainly, of course, higher ratio of those to assets. And interbank funding of assets was discouraged. Let's just then take this on a little bit further. This thing got much worse in autumn 2008 when the Lehman crisis justified regulatory authorities, rubber stamped by the G20 group of industrial nations, justified them in a move to a very much tougher bank capital regime, so-called Basel III, and banks were required to hold extra capital, punitive risk assets, say 60, 70% higher than before. This regime was under discussion from autumn 2008. The banks knew all about it. It was finalized in December 2010, but is still being implemented even today. Now, in my first 20 minutes or so, I explained why banks tended to want to reduce the ratio of equity to loan assets to boost their profits, return on capital, and similarly, they reduced the ratio of cash and liquid assets so to have more earning assets and again, more profit. But then competition drove down the cost of finance. What they were suddenly being told in late 2008, that's not the game anymore. You must have more capital. Increasing capital per unit of risk claimed on the private sector is 60, 70%. By implication, they must cut their risk assets, the claims on the private sector, by about 40%. This was a massive deflationary shock for the economy at just the wrong time. And in my view, which isn't in any sense the standard and consensus view, but I've given you the reasons, this was the fundamental reason why what should have been perfectly manageable problems in August 2007 evolved into the Great Recession. Banks were told to have more capital, banks then stopped lending, they pulled in some loans. When you are asked to, or forced to repay a bank loan, you've got a deposit there, you use your deposit to repay the loan, the deposit disappears, as well as the loan, the deposit is money. So what's happening is this huge demand for extra capital led to destruction of money balances, and that then was the key causal factor in the Great Recession, then intensified from autumn 2008. Lehman Brothers was a very small institution relative to the world economy. It could not possibly have done the amount of damage that was actually evident at that time in the world economy. It was what the regulators did that caused the Great Recession. Now, central banks then slashed interest rates. And then crucially, they embarked on, I advocated this, they embarked on large-scale asset purchases to offset the reduction of quantity of money that was then emerging. And the result of this was to boost the quantity of money and to halt the recession, so that the QE, quantitative easing, did stop the recession. It also meant that the way that the central bank got the money themselves to buy these assets back, mostly government securities, from the non-bank private sector was by issuing cash reserves to commercial banks. So commercial banks, and before the GFC, before the crisis, having had very low ratios of cash to assets, suddenly they had massive holdings of cash. I'm now going to finish my presentation. I think I've just about taken up quite a bit of time, but by showing you what's happened since the great financial crisis to the assets of the British banking system. I explained how the process of development and evolution, from as economies become more sophisticated, the banks economize on capital, reduce cash relative to assets, they get more leveraged, more fractionally reserved. This was certainly going on through the post-war period in Britain up to 2007, 2008. Suddenly reversed in a dramatic way. Demand for huge increase in capital relative to assets, and also a demand to have much more cash and liquid assets within smaller asset totals. What happened to loans to the private sector? After all, what banking is all about, what happened to loans to the private sector in Britain as a result of this dramatic change in bank regulation in 2008 to 2010, and then continuing in a sort of slower form up until today? Well, this is the ratio of bank lending to the private sector relative to GDP since 2007. And there is a complication, which is that the banks had been rather naughty in the run-up to the crisis, setting up things called sort of special vehicles, intermediate other financial corporations, where they kind of shepherded mortgage assets in order to convert them into securities. Let's cut them out. Let's just focus then on the blue line, which is where just loans to private sector, meaning genuinely loans to companies, households, and meaningful, serious financial institutions. These were about 130, 140% of GDP in 2008, 2009, somewhat higher than in earlier years, but not dramatically so. We'd had figures of 120%, 110% for some time. Anyway, from early 2009, as the Basel III regulations took effect, this ratio collapsed and it fell to a bit under 100% and then stabilized. Because of COVID, I haven't included the last couple of years here. It would have fallen off again sharply at the very end when you had a big, because COVID meant another rise in banks' claims on the government, big increase in cash reserves. But to some extent, that is exceptional. The main point here is that big fall in the ratio of lending to the private sector relative to GDP, essentially because of the tightening of regulation in 2008 to 10. That's the total. What about the composition? Here we've got lending to households, it's the blue line relative to GDP. Got lending to industrial commercial companies, and then the grey line is lending to non-bank financial corporations. I should just say that some of the data here some of the data are rather difficult to read. I have to download it from the Bank of England website. A lot of serious breaks and other issues. You can see, as far as households are concerned, it's mostly mortgage lending. There was that collapse 2009, 2010. That's a serious break. Anyway, that's somewhat misleading. The point I want to make here is that if you exclude that, the lending to households was relatively stable. The lending to companies, industrial, commercial, and financial, fell heavily. That was because of the way in which Basel III worked. Basel III was basically light, very, very generous towards mortgage finance. Obviously very politically sensitive, so the bureaucrats didn't want to upset the politically difficult area of mortgages. But the increase in capital ratios therefore fell more heavily on corporate lending. And what I've done here is to put the ratio of lending to all companies as industrial, commercial, and financial relative to GDP in this period. So before the run up to 2007, 2008, say about 40% of GDP, peaked up at around about 55% of GDP, fell back towards 25, 30%. The 5 to 7 years after 2008 led to plainly a very big fall in the ratio of loans to the corporate sector relative to GDP. One particular type of lending has been very, very weak. It's lending to unincorporated businesses, very small businesses, often just the manager and the owner, the same person. This type of lending relative to GDP peaked. It's not an important kind of lending, unless you think that some kind of this entrepreneurial lifeblood is something that matters to the economy. This peaked at 2.5% of GDP in 2008, expect, and then has collapsed, and it's now about 1% of GDP. Okay, well, that is bulk of my presentation. That shows you that the effect of the changes in regulation that occurred in 2008, 2009 has been to cause very large falls in the ratio of corporate lending to GDP in the UK. you can imagine, within banks themselves, they've closed down departments and so on because of the responding to the regulations. And plainly, this has not been welcome to banks' customers. May I say they include me, and I'm a sort of small businessman. I had loans of a few £1 million from British banks in much of this period. I don't have much today, but I'm getting on a bit. Let's then conclude that in the 25 years before the Great Recession, GFC, British banking operated, seems to me, as if in a substantially free economy, with claims on the state and the public sector being a tiny share of total assets. They had to comply with the law, they had to comply with banking regulations, their regulations in that period, of course, and they did comply with them. Having said that, banking was substantially liberalized and the economy benefited. Nowadays, British banks are highly regulated. They have required to hold far more capital than they think is sensible relative to their risks. They have much higher ratios of liquid assets and cash to assets. And of course, cash is sterile, it's unproductive, unlike a loan, which actually is extended to help investment and to help the economy work more effectively. And in particular, we've seen that there's been a big drop in lending to small and medium-sized companies. Well, I'm going to close there. My closing question really is that, has the economy benefited from the changes since 2008? Has all the extra regulation really been necessary? I would say that the tightening of bank regulation wasn't necessary in 2008. Instead, the Bank and other central banks should have lent to banks on a relatively sensible, add-up sort of basis, as in fact the banking had done until 2008, 2009. There would have been no need for all this extra capital raising, and the banking system would have helped the corporate sector, British corporate sector, much more effectively in the last 10 or 15 years if that hadn't been done. So, do we want to end the alchemy of banking? Do we want to go back to a world in which banks got 100% cash or 100% cash and government securities? I would say no. And in fact, what we should really be doing is going back to what we had in a successful period in the 25 years up to 2007, 2008. I want to get back to banking in a free society. Thank you.
Thank you very much, Tim, for this fascinating presentation on a very difficult, actually very complex matter. So it was a great summary of what has happened to UK banking, in the last 6 decades. So thank you very much for your presentation. And if you want to hear more about these topics, indeed, come to Buckingham, apply for our programs. We have 2 postgraduate programs in money banking and central banking, and we'll have another session in our webinar series in the winter. You will get more information in the next few weeks. Thank you very much.